Hello, YouTube. So as I'm going to follow up on last week's program in regards to residency, domicile, and today we're going to spend a little time talking about California residency. I put this together quickly, so hopefully there's no spelling or grammatical errors. I did use some abbreviations. I hope that's okay. I didn't really want to spend time speaking about New York, although that's where we're from originally, and we have some experience with domicile issues and statutory residency issues. As New York residents, obviously that's come up over the years quite a bit, so we're well versed in it. And here I decided to do a little bit more of a cross-reference over to California. There's a lot of similarities between California residency rules and New York residency rules. And I just want to say that at the end of the day, when people would come to us and seek advice in terms of residency, a lot of it will obviously come down to definitions and what taxpayers do or do not do. But, again, in states like California and New York, you'll definitely see that there's more than one factor. There's never really one set of rules. And if you're reading the regulations, you won't always be able to pinpoint exactly your situation. Each situation is unique and has to be looked at on an individual basis, and there's many factors. And obviously in state residency audits, they weigh everything, especially in states like California. Now, when we do render advice, we're always saying, our first question is, what's your intention? So when we're dealing with switching residencies, are you really leaving that state? Did you pack everything up? Do you have any intention to come back to that state or residence, or was this move a temporary move, especially in a year like COVID? That was the primary question that we would ask our clients is, what was your real intention? And sometimes the intention is unknown. A year like COVID, basically, many people really didn't know, and it's not up to them. So I can see how there's going to be 2020 hindsight going back in time as things are changing and evolving. It's really important to keep that in mind. So without any further interruption, let's just quickly dive through the California residency rules. And I guess there's a subsection of the code for the California Revenue and Tax Code 17041, and that's the code that specifically deals with California residency rules. And that will, of course, if you're considered a resident for tax purposes, either statutory resident or if you're domiciled in California, you're going to be subject to income taxation for California tax purposes. And I looked up the California tax rates. They're steep. It's a progressive system. It's much like the federal tax system. It layers as you earn more income. You're subject to more tax. So it ranges from 1% to 13.3%. And obviously here's a grammatical, as I said. So please excuse any typos. And that's quite a hefty amount of tax. And again, it's a progressive tax system. So the effective rate might be actually smaller. It's not so. Let's say you're in the top marginal bracket, and I've explained this in other videos, and you're in the 13.3% for California tax purposes. It doesn't necessarily mean that you're paying 13.3% of tax. It's only that income that falls within that bracket that gets slammed with that tax rate. The bigger issue here is what happens if you're a statutory resident of California and you are domiciled in New York. There are situations where you might not be eligible for reciprocal tax credits, and that's where taxpayers can get into a real bind. So planning and discussing this with your tax professional is really important. In certain situations, there might not be a tax credit for taxes paid to another state in your home state, and that might be intangible income. All right, so just like New York, they look at many variables. They tend to, obviously look at domicile, where you're domiciled, and they also look at statutory residency. So California has its own little spin on it, and what they're doing is they're saying, well, if you're located in California for other than temporary or transitory purposes, and they keep using this temporary and transitory purposes as their definition. What they're really saying is if you're in California just sightseeing or vacationing or passing through or something along those lines, then as the words imply, temporary and transitory, you're not really domiciled, you're not really a statutory resident. We'll dive in more to what can start attaching you for statutory residency. Now, that's point number one. Point number two, if you're domiciled in California but outside of California for transitory or temporary purposes, that's really obvious. So, and again, they're just defining it. So if your home, your place of where everything is near and dear to you is California, and just because you leave California for temporary or transitory purposes, it doesn't change your domicile because you didn't really intend to leave. And that's something that pops up in COVID. People jumped ship, they moved somewhere where there's not a lot of people in response to COVID-19. And what ends up happening was their intention was never to leave, and they could be here in Florida or they can be in Wyoming. It doesn't matter. It could be a year, it could be a year and a half, but everything that was near and dear to them is still back in California. They're still domiciled in California. And so when we discuss residency, we really need to discuss a little bit of that terminology, and the terminology is leaving and landing. So leaving and landing, again, it's like that intention. It's like I packed everything up. I took everything with me. I have zero intention of coming back. I have no ties. I sold everything that doesn't really is not coming with me, and nothing really attaches me back. So it's very similar to New York's concepts, where when they look at domicile, it's almost identical, I'd say, in many respects, except California kind of defines it slightly differently, but they're really talking about the same thing, and they start weighing things out and defining them a little bit better. And I can see states in the future are starting to define more and more how their domicile is determined, or how their statutory residence is determined. Remember, by law, they're allowed to define it any which way they like, and I can just see them going into all these different directions, each state with their own definitions. Now, again, temporary or transitory purposes, as mentioned, is passing through the state. You're there through rest, vacation, sightseeing, etc. for temporary work assignments. What is other than temporary transitory? Well, California describes that as you showed up to California to improve your health or maybe an illness, and you're required to be there for some sort of indefinite period of time. That's not very clear, but it is what it is. Or you came to California for business or maybe retirement, and you have no intention of leaving anytime soon. Obvious, right? So again, this is very similar to how New York defines residency as well, except they don't really have that specific language. But I'm sure if you start looking through case law, you'll probably be able to find cases that deal with that sort of issue, where people would come into New York and they would stay there for 4 years because they had a medical center or something like that. Well, that's more likely going to look like they're resident. And New York will also look at all these different factors the same way California does. So California has this closest connections test, where they're looking at, and it's self-explanatory, right? They're looking at what's the closest connections of this person, where is everything that defines this individual as a whole. So in other words, where's their ties, right? Where do the people that they know work with, do business with, and have professional associations, and all of these other things? They're basically put into 3 categories, which is, 1 is the registration and filings, 2 is personal and professional associations, 3 is physical presence and property. And just like New York, they weigh everything and say, well, you're really connected here. I mean, look at where you're registered to vote. Look at where your vehicles are. And this is where it can get really hairy, because in real life, right, people have more than one home. They have more than one car. One car is registered in California. One car is registered in New York. They have a home on the East Coast. They have a home on the West Coast. It's very possible, just like we talked about Jeter, and he was being pulled into audit with New York State tax commissioner. Why? Because it's not a clear-cut case. It's very convoluted. With most people, it'll be very clear. They picked up, they left, they never came back. It's a wrap. It's very simple. They left no ties, no connections. And in some cases, you might leave some ties or some connections. I'll give myself as an example, right? I'm licensed in New York as a CPA, but I'm also licensed in Florida as a CPA. That doesn't bring me back to New York for taxation. And by the way, Freyman CPA is a New York company. It still doesn't bring us back to taxation for New York State income tax purposes for us personally, because that's like really the only ties we have left. But there's an abundance of ties and connections that we've made here in Florida, new clients, a new home, and so on and so on. Everything just like a mountain of things here in Florida, and literally one thing there. So they look at everything, they weigh everything out. And what a reasonable person would say, yep, it's pretty clear, you're a California resident. So they would look at everything. They look at intention as well. Although intention is much harder to prove. They also look at where the time is being spent, and because for some people it's not very clear. They're very involved with many different things, and they start to weigh it out, and they'll weigh it out over years. They won't weigh it out overnight. They have to actually look at things on multiple levels, you understand? And it can really come down to start and basically putting things on one side and just basically weighing them all out, and looking at really diving into a lot of details, such as, where are the transactions being originated from? Is this person transacting from California, or is this person transacting from New York State? And where do they attach for tax purposes? And so obviously just getting a voter registration in California will not make you a California resident, because you might have spent 2 months there, right? Anyway, so that's basically the closer connection test. Now, California has a couple of more things that I'll touch upon, and we'll call it a wrap for today. They have the 9-month presumption rule and the 6-month safe harbor rule. And that's them just trying to really pinpoint a little bit closer to who would be tied in for California's basically residency and tax purposes. And if you're looking at the 9-month presumption, so if you're in California for more than 9 months, they basically presume you to be a California tax resident. But, again, if you're in California for less than 9 months, that doesn't automatically make you a non-resident either, right? So again, back to the square one, back to saying we have to weigh everything out, look at all the variables, and see where you're connected to more and what's the intention. So I can be in California for 3 months. I literally could have picked up from Florida, moved to the West Coast, make my intentions from October onward of 2021 to become a California resident. I'm a California resident as of that moment because of my intentions. It doesn't matter that the year was 3 months short. I'm not going anywhere. I'm going to leave, and as they say, leave and land. And leaving Florida and landing in California and starting to put in the roots there would change that whole scenario. So that's the 9 month. I won't be able to say, yes, I landed. I was there for 3 months. All my intentions are to be here, but I'm not a California resident because it's under the 9-month presumption rule, right? Again, everything with a grain of salt, looking at it from many angles. The 6-month safe harbor, same idea. If you're in California for less than 6 months, they have a safe harbor as long as you've domiciled somewhere else and you have a principal place of abode, which is like a home, a rental, something along these lines that belongs to some other state. You're basically considered to be in California for temporary transitory purposes, and you're safe from their high tax rates. But again, not in every case, right? Just as I described in the 9-month presumption rule, the same can apply to the smaller than 6-month rule and vice versa. So just gives you a very good idea of how convoluted residency tax audits can be, and what to think about when you're moving out of one state or another. And again, just to reiterate, when they're looking at these situations, they're not actually going to look at any one specific thing. They're going to look at many things and over a period of years as well, especially California. California tends to look at things over 2 to 3 years. All right, well, this is Greg Freyman from Freyman CPA. Again, thank you for checking out our channel. We love that you guys are part of what we do. If you like the content, give us a thumbs up, leave us some comments. Let us know if you'd like to see something interesting or new, and we'll definitely reach out and see if we can do that. Thanks, and have a great day.